What are options? Today, let's dive into the topic of options, using a simple example to explain. Meet Sam, a successful potato seller in the local market. He runs a great business and makes good money from all the potatoes he sells. Now, let's meet Robert and David, two unemployed young men looking for an opportunity. Robert and David brainstorming, eyeing Sam's busy potato stall. They have an idea. What if they open a betting shop right next to Sam's stall, but of regular betting, they focus on the future price of potatoes? Robert and David setting up their betting shop and a sign that reads "Bet on Potato Prices," with one lot as 100 pieces of potato. Their plan is to let people bet on whether the price of potatoes will be in future. It may rise or fall. Those who think the price will go up can buy what's called a call option, while those who believe it will go down can buy a put option. Let's say someone believes that by September 30th, the price of potatoes will rise from current price of $22 to $30. They buy a call option, betting that the price will rise above $30. Another person who thinks the price will not go higher than $30 sells that call option. Similarly, if someone believes the price will drop to $10, they buy a put option. And if someone believes the price will not drop below $10, they'll sell the put option. Also, one lot of these potato bets represents 100 potatoes, so any outcome would involve trading this quantity. Options can be classified as in the money, at the money, or out of the money. Here's what that means. If the current price is $22, the $20 call option and the $25 put option are considered at the money, meaning they are equal to the market price. A call option is in the money if its strike price is lower than the current market price. For example, if the price is $22, then a $15 and below call option is in the money because the market price is higher. On the other hand, a call option with a strike price of $30 or more is out of the money, as the market price hasn't reached that level. Similarly, a put option is in the money if its strike price is higher than the current market price. So, at $25, a $30 or more put option is in the money, while a $15 or less put option is out of the money. This concept helps traders decide which options have intrinsic value and which ones might expire worthless. Now, it's September 30th. The price of potatoes has reached $32. So, what happens? The person who bought the $30 call option wins because the price rose above $30. The person who sold that call option loses because the price exceeded their bet. As for the $5, $10, $15, $20, $25, $30 put option, it expires worthless because the price didn't fall below $30. Here's how it looks. The $30 call option is in the money with a value of $2, since the market price of $32 exceeds the strike price. The $25 put option is out of the money and expires worthless. Similarly, a $35 call and a $5 put are out of the money, while $15 calls and $25 call are in the money based on the final price of $32. The winners will get their reward, and losers will lose their capital. Robert and David will facilitate the transaction and will get transaction fee. Their unemployment problem is solved and they have a rewarding career. They are called market makers, and the brokers which help people bet will get their commission. Potato betting results, rewards, and losses. If the buyer of the $30 call option decides to exercise their option, Robert and David would have to buy 100 potatoes from Sam and sell them at the agreed price of $30 to the buyer. As the current price is $32, the $30 call option seller will provide rest of the $2 and take the loss. Option contracts. These contracts, or options, are made for each month, allowing people to bet on potato prices for up to a year, expiring on the 30th of each month. But how do Robert and David decide the price of these contracts? The price of each option contract depends on various factors: how volatile the market is, how far away the expiration date is, and, of course, supply and demand. Options allow traders to speculate on the future price of an asset. just like these potato contracts. Options as a financial tool. Options, originally created for hedging, allow investors to mitigate risk. By purchasing options, they can protect their positions, or anticipated positions, in assets against adverse price movements. This makes options ideal for controlling risk without needing to sell the underlying asset. Over time, options have evolved from simple risk management tools to active trading instruments that can generate income through strategies like selling covered calls, writing puts, or engaging in spreads like iron condors. Traders now use options for speculation, leveraging relatively small amounts of capital to potentially achieve larger returns by taking advantage of market volatility and price direction. Option buyers. High loss rate for option buyers. Around 95% of option buyers lose money because they pay a premium to hold options, which decays over time. Out-of-the-money options. Most option buyers purchase out-of-the-money options because they are cheaper, but these options decay very quickly. Lack of credit spread. Strategy. Option buyers often fail to use strategies like credit spreads to cover losses when premium decay occurs, especially if the market doesn't move in their favor. Perception of gambling. Many treat buying out-of-the-money options like gambling, hoping the price will rise significantly. Market makers. Advantage. Option buyers are essentially betting against market makers, and by analyzing open interest, it's possible to determine the positions option buyers are holding. Short-term price movements. In the short term, prices can move in any direction, but option contracts have a fixed expiration date, unlike stocks, which can be held indefinitely. Time sensitivity of options. Unlike stocks, which can be held for a lifetime, options are contracts bound by time and expire after a set period. Option sellers. Premium collection. Option sellers receive a premium upfront when selling options, giving them an immediate profit unless the option moves significantly in the buyer's favor. Time decay, theta. The value of options decreases over time due to time decay, theta, which works in favor of sellers as the likelihood of the option expiring worthless increases as time passes. Higher probability of profit. Option sellers have a higher probability of success because most options, especially out-of-the-money ones, expire worthless. This allows sellers to keep the premium. Betting with market makers. Option sellers generally align with market makers, who have deeper knowledge of market flows and dynamics, improving their odds of success. Managing risk with credit spreads. Many option sellers use strategies like credit spreads to limit their risk while still benefiting from time decay and price stability. Market stagnation. Benefits. Option sellers make money even when the market remains stagnant or moves less than expected, as the options they sold lose value. They don't rely on large price movements like buyers do. In this video, we learned what is a call and put, what is in the money, out of money, and at the money. What are option contracts, role of market maker and broker, how an option contract is assigned and exercised. Who are option buyers and sellers? Thank you. If you like the video and want more informative content about how to be a successful option seller, please like the video and subscribe by clicking the bell icon. It will really make my day.